Every quarter, investors dissect earnings reports, income statements, cash flow statements. They build models, run screens, listen to calls. Almost nobody reads the proxy statement. That is a mistake, because the proxy statement, filed with the SEC as DEF 14A, is the one document where a company has to tell you exactly how much management is being paid, exactly what the board looks like, and exactly what shareholders actually voted on. It is also one of the most carefully worded documents a company produces. Every sentence is written by lawyers who know what they are trying to obscure. AI changes that. Let's get into it. The proxy statement is filed before a company's annual shareholder meeting. Most investors never look at it. The ones who do get an edge that the income statement cannot give them. Here is what it contains: executive compensation, base salary, annual bonus, long-term equity awards, perks, pension benefits, severance packages, the full picture of what management actually takes home. Board composition, who the directors are, how long they have served, what they are paid, and, critically, how independent they actually are. Shareholder votes, every item that went to a vote, director elections, say-on-pay resolutions, shareholder proposals, including the results, related party transactions, any business dealings between the company and its directors or executives. This is where management accountability lives. The earnings call is rehearsed. The proxy is disclosed. Prompt 1 is about the money. Go to the company's most recent DEF 14A on the SEC's Edgar database. Find the summary compensation table. Paste it into your AI and use this prompt. Analyze this executive compensation table. Break down each component of CEO pay, base salary, non-equity incentive plan compensation, stock awards, option awards, and all other compensation. Calculate what percentage of total compensation is fixed versus performance linked. Identify the performance metrics used to determine the variable pay and assess whether those metrics are rigorous, easily manipulated, or disconnected from long-term shareholder value creation. Most investors look at the total comp number and stop there. That is the wrong move. What matters is the structure, and whether the structure actually aligns management with shareholders. When you run this, you are looking for three things: pay mix, a CEO whose compensation is 80% fixed and 20% variable is not being incentivized the same way as one where it's reversed. High fixed pay with weak performance linkage is a governance warning. Metric quality. Revenue growth is easy to manufacture. Earnings per share can be inflated with buybacks. Return on invested capital, free cash flow per share, total shareholder return relative to peers. These are harder to game. If the metrics are soft, the incentive is soft. Alignment versus entrenchment. A CEO earning $40 million in a year where the stock fell 30% is telling you something about who the board is working for. When AI flags that disconnect explicitly, you have information most analysts bury in footnotes. The compensation table is not just about fairness. It is a signal about governance quality, and governance quality predicts long-term outcomes. Prompt 2 goes after the board. The board is supposed to represent shareholders. It hires and fires the CEO, approves compensation, and oversees strategy. In practice, many boards are captured, filled with longtime directors, personal connections, or executives from other companies where the CEO sits on their board. Find the director profiles section in the proxy. Paste the director names, tenures, committee memberships, and any disclosed relationships. Use this prompt. Analyze this board of directors. For each director, identify their tenure, their primary occupation, any board interlocks with this company's executives, and any disclosed relationships. that could compromise independence. Assess whether the board's audit, compensation, and nominating committees are genuinely independent. Flag any directors who have served more than 12 years, any interlocks, and any patterns suggesting the board may be captured by management. Board capture is subtle. It rarely shows up in a headline. It shows up in compensation approvals, in watered-down performance targets, in CEOs who stay too long. Here's what to look for in AI's output: tenure creep. A director who has served 15 years was likely appointed by the current CEO or their predecessor. Long tenure erodes independence even when the director believes they are objective. Interlocks. If the CEO sits on the board of a company where one of the directors is a senior executive, that is a board interlock. Both parties have an incentive to be generous to each other. These are disclosed in the proxy and easy to miss without AI. Committee stacking. The compensation committee approves executive pay. If that committee is not genuinely independent, the CEO is effectively negotiating with allies. Check who is on it and whether any of them have disclosed ties to management. A well-structured board is worth paying for. A captured board is a risk you are not being compensated for. Prompt 3 is about the votes. Every proxy includes the results of the shareholder meeting. These results are filed in an 8K within 4 business days of the meeting. They tell you exactly how shareholders, institutional and individual, responded to what management put in front of them. The most important vote is say on pay. This is a non-binding advisory vote on executive compensation. Non-binding means management does not have to do anything with it, but it is a signal, and when the signal is loud, it matters. Find the voting results in the proxy or the subsequent 8K. Paste them in and use this. Analyze the most recent shareholder vote results for this company. Focus on say-on-pay approval rates and director election results. Flag any say-on-pay vote below 80%, any director who received more than 20% opposition, and any shareholder proposals that received significant support. Identify whether opposition has been increasing or decreasing over the past 3 years and what specific concerns appear to be driving it. Most say-on-pay votes pass with over 90% support. When they don't, it means something. A say-on-pay vote below 80% is a serious warning. It means major institutional holders, BlackRock, Vanguard, State Street, voted against the pay package. These are not activists. They are the largest shareholders in most public companies. When they vote no, it is because the compensation structure is indefensible by any standard framework. Below 70% is rare. When it happens, boards are expected to engage with shareholders and change something in the following year. Director elections tell a different story. A director receiving 30% opposition in an uncontested election is effectively being told by shareholders that they should not be there. Most will stay regardless. But the signal is in the record, and AI can surface it across multiple years to show whether the opposition is growing. Voting trends are the governance equivalent of diverging cash flow. They show you pressure building before it becomes a crisis. The bonus move is the section most investors skip entirely. Related party transactions are disclosed in the proxy under a section that is usually titled something like Certain Relationships and Related Person Transactions. It covers any financial dealing between the company and its executives, directors, or their family members. Sometimes these are routine and immaterial. Sometimes they are not. Paste this section into AI and use Review these related party transactions. For each transaction, identify the parties involved, the dollar amount, the nature of the arrangement, and whether it was approved by independent directors. Assess whether any transaction appears to benefit an insider at the expense of the company, whether pricing appears to be at arm's length, and whether any pattern of transactions suggests ongoing wealth transfer from the company to insiders. A company that is consistently leasing property from a director's family trust or routing contracts through an executive's consulting firm is showing you something about how the organization views its shareholders. It is in the disclosure. Most people never get there. 3 prompts, 1 filing. A completely different picture of a company than the income statement gives you. Prompt 1, executive compensation structure. Is pay aligned with performance or with tenure and relationship? Prompt 2, board independence audit. Are the people approving compensation and strategy actually independent or captured? Prompt 3, shareholder vote trends. What are the largest institutional holders telling you through their votes? And is the signal getting louder? Bonus, related party transactions. Is anyone taking money out of the company through the back door? The earnings call tells you what management wants you to focus on. The proxy statement tells you how the organization actually works. Read both. Next episode, we shift gears completely. Technical analysis, how to use AI to read a chart, identify key levels, and separate signal from noise. See you Thursday.